Hi, and welcome to another exciting day of our programming from COP in Dubai. We are joined today by a fantastic panel, and we're really attacking something that's at the heart of the discussions here at COP, which is how do we secure an inclusive and high-energy future for emerging markets? I'm Aubrey Ruby, and I'm a senior fellow at the Africa Center at the Atlantic Council. And at the Africa Center, this question is near and dear to our hearts because 600 million Africans lack reliable access to energy. And that's 80% of the population that lacks access in the world, so a heavy concentration. And we know that investment is, instead of increasing at the rate we would need it to make a dent in that population, it's actually not only flatlined, but somewhat decreased in key areas. So today we're really going to dive into this topic, and I'm so pleased to be joined by Anna Hajduka, the founder and CEO of Africa Green, and Mauro Soares, the co-founder and COO of Relp, to jump in here. So first, let me turn to you, Anna, and see what is Africa Green, and what are you doing at COP, and how are you seeing the week's discussions? Is it progressing in the right way, or where do you want to see it end up?
Thank you very much. Africa Greenco is the newest buyer of renewable energy in SADC region of Southern Africa. In and across sub-Saharan Africa, in order to scale up new renewable energy generation, you have an issue with lack of creditworthy buyers. The state utilities are heavily indebted, and the fiscal space of the countries in question is also very heavily indebted. Yes. So the only model that worked so far is the ability of the private sector to sell to an already heavily indebted state utility, and then those power purchase obligations to be effectively guaranteed by already indebted state fiscal, meaning we're just shifting the financial risk. So if we look at the IMF contingent liability reporting of most countries in sub-Saharan Africa, that model cannot scale. Yeah. So at Africa Greenco, we are the first private sector buyer and aggregator of renewables. Okay. We work directly with the state utilities to showcase to them the value of the decarbonization journey by delinking these power supply and volumes coming on board away from their balance sheets, but at the same time monetizing their services to the private sector, meaning use of system, banking, balancing. So we are working on a kind of systems change basis.
Yeah, we had a panel yesterday when we were talking about the kind of financial architecture, the green climate finance architecture that will work for Africa, and exactly what you're talking about, intermediation in a space where the off-taker, usually the utility, is not able to do that in a credible or bankable way.
The only other thing is financial engineering of those solutions is not enough. So we are bridging the financial engineering with the actual movement of electrons across the power pool in Southern Africa.
Fantastic.
So we are de-risking it physically as well by the movement through power trading on a regional basis of the actual supply. Because these are 20 to 25 year long-term power purchase obligations, and if we mitigate the risk financially only, eventually we'll have a systemic problem.
Well, and I don't always like to focus on the challenges because they're enormous. And one of the bright spots over the past, let's say, 10 years coming out of the Africa energy space was South Africa's experience in introducing a large renewable chunk into their energy mix through the program.
Sorry that I'm going to be a little bit,
I'm
going to turn it around because it's the most positive example in sub-Saharan Africa. More than 3 gigs brought on board of intermittent renewable energy supply. However, I wish they did it better. Yeah. Because if you have 3 gigs of intermittent supply, that has added, as of today's date, $32 billion on the national treasury of South Africa, according to the latest IMF calculations. In addition to that, Eskom, the South African utility, they need to balance all that intermittency through their coal power generation,
Yep.
which is not easily dispatched, i.e. easily, you can't just turn it off and on
Yep.
as you could hydro, etc. So from the system stability perspective, I wish it was delivered a little bit differently,
Oh, that
which
makes
is
sense.
what South Africa is realizing now, with ESCOM no longer being able to be the buyer because of all the IMF restrictions, with a country no longer being able to afford anymore. Now they're moving to private model and introducing a competitive market in South Africa.
Fantastic. Thank you for that insight. And I think the average South African in their experiencing of the brownouts would agree that the challenge remains.
Yeah.
Mauro, I want to bring in you on this question of how do we get more energy investment in? What are the opportunities, and what's the role that Relp is playing?
Okay, well, thank you for having me today. Relp is kind of an innovative endeavor that we started a few years ago. It's philanthropic backed, and we come from working in the private sector. Most of our professional career happened in, I'm talking about myself and the team. And then we went to work for the government. For 4 years, we were leading the government team that implemented the procurement in Argentina. And out of that successful experience of having mobilized 5 gigawatts of renewables into a grid, that the difference with the South African case is that it has a lot of natural gas and hydro, so it's much easier to balance than the South African case. We are now having 18% of the electricity coming from the projects that we mobilized as part of this program.
In which country?
In Argentina.
In Argentina.
So we started an NGO to bring that experience to other countries in the developing world. So that's what we do. We engage directly with the governments. We provide them technical, what is usually known as technical assistance, but not the typical one that the consultants do, but a more long-term relationship-based. And we're fully philanthropy-backed, so we can provide that from a very independent place where the basis of what we do is building the trust with the government, helping them build the teams and the capabilities within the team so that they can procure longer term and repeatedly.
It's so important because all too often when you talk about opportunities to learn from other markets, often the examples given to African countries are those of developed countries. And so with the Argentinian case of high inflation, the challenges around default and credit rating, I think that learnings there can be very applicable to some of the challenges faced in other countries.
Yeah, and to speak to that, the most important piece is doing the right risk assessment and then de-risking the market with a program that takes into account the right risk allocation and some instruments that might mitigate specifically counterparty and political risk and some macro risks. So for that, we're developing a we're developing a fund to provide liquidity with a blended financed approach where we stack some government contribution for them to have skin in the game. We stack catalytic capital from philanthropy, some equity from MDBs and DFIs, and some credit lines on top of that. So with that, we can provide for free a liquidity solution that might unlock the many markets. And on top of that, we arrange long-term early termination backstop to the sovereign to provide an enhancement to the whole scheme in a pre-positioned way so that, when you run a procurement program, most of the risks have been identified and something has been done about each of those risks. So the investors feel more comfortable, lenders feel a lot more comfortable. You can bring down the cost of electricity up front, right? And really materialize a better result and a more sustainable result for that country. So
digging in a little bit on that question, because outside of the Atlantic Council, I spend a lot of my time investing in innovative startups across frontier markets, and we always talk about innovation in the private sector. What kind of innovations are you seeing from governments to address these issues across emerging markets. Are there examples in Argentina or other places in Latin America that you can point to or countries that have done it very well? And then Anna will come to you as well.
Well, there are a few countries that have been successful. There's a lot of fragmentation. There are many countries that are way behind in terms of developing capabilities. Some others have been, I mean, there's some success stories. One is Argentina, but Brazil, some regions of India can be taken as good examples. All around Latin America, auctions have been quite successful. But they respond
auctions for what?
Auctions for renewables.
Okay.
I mean, I'm talking about mobilizing renewables at scale,
Yes.
right? Then I mean, we're not experts in distributed renewables, right, or access. I mean, our mission is to scale renewables at generation side, right? So there are several examples of success cases, but unfortunately not many in Africa or Asia in terms of, well, in Asia there are some like Malaysia or Thailand, maybe are more advanced markets. Many others still lack a lot of drive to really provide that place where investors can feel comfortable monetizing their projects.
Yeah, that innovation from government can be critical. You know, a market I know very well is Nigeria. 60 million generators, discussions of, you know, the problems with the Gencos, Discos, the whole thing for 25 years. And if you wanted to increase Nigerian GDP tomorrow, you got to get the lights on, right? And so where does the innovation come in from the government side? And then, of course, intermediation of what you're doing is critical. But other examples of government innovation?
On the government innovation side, I think Nigeria, talking to Nigeria, tried through NBET, but I realized that NBET as the new buyer, effectively, or backstop buyer for new generation, reaches or hits the country's ceiling eventually.
Yeah.
So it cannot diversify its own risks.
Because it was backstopped by the World Bank, right?
Yes.
Exactly.
But now that the West African power pool is actually becoming much more active, if NBET and the likes can link to the power pool, you can then start diversifying the national risk from Nigeria into the power pool. So in Southern Africa, where we work, so Greenco is active in Zambia, Zimbabwe, Namibia, and South Africa, huge amount of innovation. So the ZESCO MD was on the panel yesterday, the Zambian Pavilion, showcasing how important Zambia is for decarbonization and electrification of the rest of the Southern African region in order and due to the fact that they are 86% hydropowered. So Kariba Dam, etc., is going to be utilized as a bank for absorption of intermittency on a regional scale, because ZESCO is also, as a utility, one of the balance control area operators of more than one country in the region. And the region just introduced a regional balancing market, huge innovation, based on the North Pool with the same system, so it's moving. We signed on Sunday with the government of Zimbabwe the first use of system and system operation open access agreements with the utilities, okay, giving us access to their networks. This is first of its kind documents. Wow. And on Saturday in the Zambian Pavilion, we signed the first ever in Africa merchant power transaction. It's a new power purchase agreement signed with us as a buyer, that provided by FMO and other reputable DFIs, including AFDB, on the back of exposures only to the competitive markets of the Southern African power pool. Ah. In 2017, when I mentioned that at COP as an idea, I was genuinely laughed out of the room and called crazy by all the other panelists, without even beating around the bush. Yeah. They said Africa is not ready for that, as if somehow the transition to competitive market is so incredibly difficult. It is ready, it's doing it, it's been trying to do it regulation-wise for a long time. It's just that the financing world is now waking up to the fact that, okay, perhaps we can mitigate risks in a different manner.
And zooming in on the investor side, what type, once you have these kind of innovations in place, and I know many of them are new and untested, but what kind of investors are looking to come in, and how can we scale that? You know, one of the things I've faced in my career over working across 30 African markets for 20 years is forever the challenge of trying to sell African opportunities to entities that always feel there's a higher risk for various reasons. And there are real risks, currency risk, political risk, but some of these risks are mitigated, and they're mitigated in other regions of the world. So there's always this kind of risk premium put on Africa. So would love to hear a little bit about the investor set and how we can scale that and bring new people to the table.
So in our case, as Africa Greenco, when we started, we needed what we called, or what the investors called, quite rightly, high risk, high impact capital.
Okay.
So the Danish government through IFU is one of our shareholders, and the Private Infrastructure Development Group through Infraco Africa is another one.
Yep.
So they needed to give us capital to make us creditworthy in the eyes of the lenders to the generators that will sell to us.
Yeah.
And we were stunned that in South Africa, we thought the first mandated lender on the back of a new power purchase agreement with us will be the DFIs. And yes, in Zambia, they are DFIs, FMO and AFDB, but in South Africa, the first PPA we signed as a private sector buyer, 85 megawatt solar PV, Standard Bank is the mandated lender. Mm-hmm. And it's incredible that a commercial bank could be leading the way on the back of a completely new business model in Africa.
Mauro, in Latin America, I asked the same question. Is there a different investor set? Do you see the same kind of dominant role of the DFIs in de-risking these transactions? Or do you see local capital coming to play?
No, it depends on the stage of development of the market. In the case of Argentina, the first and the largest deals on the first round were led by the DFIs, bringing the typical AB loan structure with other partners, mostly other DFIs. But then there are other transactions where local companies have been able to issue some bonds. But as the market matures, right, and the local developers also demonstrate that they can execute on their projects, that the local supplier and the supply chain is there. So it's a question of how the market matures over time, right? So you start, and you have to start, and that's the role of the MDBs and the DFIs, to take that earlier, riskier market position. Yeah. And then as the markets evolve, but in order for the markets to evolve, the country has to provide that visibility going forward, that it's not just a one-off try to make it work, that it's part of a program that the government is engaged, and that's what we're trying to achieve in other markets as well. Now we're not working in Latin America. We're supporting, for example, the government of Jamaica, right, okay, which is quite interesting market, but very nascent in terms of renewables. They only did an auction about 5 years ago, and now they're having their second one that we helped them design. And we're starting to work with Pakistan, that has procured renewables 4 or 5 years ago, but now is having lots of issues with curtailment, etc., because of how the grid is operated and how the grid is, and how the procurement was done. And yeah, also there are lots of lessons learned that we're trying to bring from one place to the other, and that sort of work is very needed, right? And the de-risking instruments are different in different markets. So when you have an interconnection between countries like you do in the Southern African pool, on the West African pool, you can bring in the sort of innovation that Anna is talking about. Other countries are more isolated, yeah, and the market reform takes a very long time to happen. So what you do as a government, do you wait until you can implement those reforms and then wish for the investment to come? Or do you try to mobilize and bring enough comfort to the investors so that they can move fast, and you can start decarbonizing, you can start lowering your dependency on imported fuels, right? You can start bringing in knowledge and investment from places that have done this before, and you start that transition earlier while the market transitions to another scheme where there's more competition, where it's more like what we all like to have as a power market. But they're dominated by state-owned entities, vertically integrated. So you go and invest in a wind farm or a solar farm in a country, and your off-taker manages a grid, And so how do you deal with that? I mean, how do you deal with that discretion? Can they discriminate against your PPA? Because they have 2 years down the road, they got a cheaper PPA. So they dispatch the cheaper PPA, that they don't dispatch yours. That kind of issue is what is in the mind of investors. So that has to be designed, the procurement has to be designed differently to address that. And the government and the state-owned entities have to understand those risks and of course be willing to mitigate them in the right manner. If there's no willingness to do things in a way that brings in, I wouldn't say only international or private investor support, but the right kind of investor support and the right kind of competitive mood, so that you're not paying, because many private investors would go to a country that is risky and just de-risk it one-on-one with the government. I want this and this and this and this. But that's a one-off, and that's a one-off shot.
But again, and as
it doesn't
Anna
scale,
was
and
saying,
that's what we're trying to change.
You just, in the African government case, in many countries around the world, they don't have the fiscal space to do that. They cannot just sign all these government guarantees anymore, sovereign guarantees. And asking for a sovereign guarantee means they have a whole long process of going back to the IMF and dealing with their ceiling. So you can't even do that at a scale systematic way.
Well, speaking to that, specifically about the IMF, it depends on how you design the guarantee program. If it's just a typical guarantee like the ones that Africa implemented, where they cover almost anything that may happen, right? That has to be booked. But if you design to cover only specific events and you have a liquidity facility, you can work around to be contemplated as a one-off guarantee that can be kept off the balance sheet.
And what's the role of insurance in that process? So
I'm
and
not
the IMF,
sure, because I wish the IMF was in the room. Because you see, if I may just interject, KPLC in Kenya and the government of Kenya thought that the IMF and the World Bank agreed to that. So what they did is they didn't give a government support agreement. They didn't give an implementation agreement. They gave something called just effectively support letter from KPLC. Notwithstanding that, in I think 2018, when the IMF came in to do the Article 4 calculations for Kenya, they suddenly went out into the market saying that Kenyan government has hidden billions of US dollars of contingent liabilities for the power sector. So the Kenyan government quite rightly stood up and said, well, how? We didn't give any government guarantees for these power purchase obligations. And then the IMF said, oh, actually it doesn't matter if there is a guarantee or not. It's a take or pay contract. And effectively the demand risk sits with the government of Kenya.
Liability.
Therefore, we're putting it as a contingent liability.
But the issue is a famous take or pay provision of the PPAs.
Exactly.
And that's what countries need to avoid and mitigate some other way. It's not easy.
It's not easy,
but there are ways to mitigate that.
Agree.
And that's a problem. The easy way is to provide a take or pay provision. And the governments get stuck with that. Pakistan is just swimming in all this debt with the power generators, because all the generation is take or pay, and that's crazy for a country that is developing. And you don't want to know the kind of IRRs that some investors have. It's unbelievable. Guaranteed IRRs, double-digit IRRs.
And so
it's unbelievable. The developing world cannot afford that, and the developed world cannot continue to do that kind of thing in the developing world.
And therefore, the investors shouldn't require it in those PPAs.
No.
Even DFI investors, if you tell them bank non-take or pay PPA, I mean, bless the DFI investors who are supporting us. I don't want to upset them through this panel. But
Me
I
neither,
haven't
but-
seen many, even DFI investors take
Yeah,
non-take
but
or
sometimes
pay.
it's so difficult to understand some of these issues that the route is, okay, we get it done always in the same manner. We have to do things differently, right? If you have, I mean, you have a take or pay provision for many reasons, right? One is, for example, that there are no clear dispatch rules
Exactly.
in the grid. So the grid is not well managed. The auction is run without taking into account the capacities of each interconnection point.
The
and-
transmission and distribution.
and the relationship and the flows between those interconnection points. That's typical. So then comes a lender, runs the numbers after the auction or after a PPA has been signed, and they say, I cannot finance 70% of this because you're not going to be dispatched. So you have 5% curtailment. So I'm going to lend you less money, and you are underwater. So that has to be considered ahead of an auction or ahead of signing. And if you have good dispatch, or if you have a way to accommodate the priority of a project that is awarded in a competitive tender versus another one that comes merchant after that, of course, the one that was procured has to have a right on top of the other one because it has been financed. The merchant comes, and that happens, it's unbelievable, but it happened in many, many countries because of not considering that kind of risk. The next solar comes cheaper, merchant, and then curtails the others and ruins the business of the others. So how do you mitigate that? With a take or pay provision? No.
Yeah.
But if
Because
it's
you're
true-
keeping the off-taker in the hook with a 20-year agreement.
But if it's true merchant, the merchant has to rely on spare capacity after all the fixed contracts have been
Exactly.
passed.
Yeah, of course.
So it's the risk of the merchant shouldn't curtail
Yeah, but that
the others.
doesn't work that easily in many places.
So speaking on that, Mauro, I mean, you mentioned Jamaica and Pakistan, really different countries. One small island nation, though large for the Caribbean. Other one, very large country, though small compared to India. So what different innovations, what can small countries do? Because this is something that I deal with all the time in African markets because they don't all have the advantage of being South Africa or next to South Africa and being part of a power pool that's functioning. And many are small. Many of them have population, I'm thinking Liberia, Sierra Leone, less than 5 million people. So how do you think about small countries and what they can do to attract renewable investment?
Well, they have many issues, right? Like the power sector has a structure that at times is hard to deal with because it's in the Caribbean, most of the utilities are privately owned, and they're not considered a public service. So they are kind of an entity that sells electricity, but they're not regulated in the way that they're regulated in other markets. So the problem there is that oftentimes the utilities are well financed because tariffs are very high. Some of these countries are paying 20, 30 cents a kilowatt hour for their electricity at the residential and commercial rate. But of course, the cost is high because they burn diesel mostly. Some have some LNG, some have some little wind here or there, but very high cost electricity. And then you have to change that dynamic, and so they need some market reform, or they need to sometimes create a separate off-taker to provide, or they need to split, and that takes time, and it's proving to be very difficult. Need to split the roles of the system operator and the utility, the distribution, the dispatch, and they need to build capabilities, and it's very difficult.
And I assume that's
on
where
top of
Relp
that, there's
comes
small
in.
islands. And so what they're planning, and we're supporting that, is that renewables have to come with some kind of storage because you need to balance somehow, right? So pure wind and solar will not make it there because it's just physically not feasible. So you need some kind of storage integrated.
Yeah. So we're running out of time, but one of the things I want to kind of talk about is a little bit the opportunity that the Ukraine war has presented to some markets to fuel other markets. I'm thinking about exports of renewables and other energy from, say, North Africa to Europe. And as countries think about their energy mix, how are global dynamics affecting it in terms of export opportunities? Even though we know there's a lot of domestic need at home. I don't know, Anna, have you thought about that? I know you're in a part of the world that is less likely to do that, though maybe Mozambique at one point is thinking about LNG exports. But how does this work in a global context?
I mean, to be honest, I don't see many opportunities in the countries that we work with, except for the fact that people are literally going hungry. I live in Lusaka, my family lives there, we are very lucky, we live a cushioned life, but most of our neighbors can't afford a milli meal because it's expensive, and it's all mostly caused due to the food inflation, results of the embargo on the export of grain from Ukraine. So maybe if you are in Nigeria or Mozambique and working on huge LNG projects, there could be an export attraction, or Morocco with the proximity, Egypt. But where I live, it's been utterly disastrous. Yeah. So for most of the population, for the countries, for the economies, the price of fertilizer, the price of grain, I mean, it's a disaster.
And it's important to bring these, I mean, we've had a robust conversation here about the kind of architecture that it takes and the financial engineering and the intermediation, but then to bring it down to what it means for people's lives. Mauro, you mentioned 25 cents kilowatt hour, 30 cents. I mean, Nigerians are paying 40-something cents a kilowatt hour because they're using diesel. Now the subsidies are off diesel, which is probably a long-term good thing, but a very difficult thing for the population. And so now, for example, in Nigeria, a lot of the companies have gone to work from home again because transport and fuel is so expensive. So people just cannot afford to commute. And so, yeah, there's a lot of taker of the constraint rather than the opportunity. Are you seeing any other opportunities in the market?
I see the opportunity is more evident. I mean, the need is more evident because all these countries are really suffering a spike in fuel. They suffered the spike in fuel costs. Now it's more moderated, but they realized. I mean, it became very evident how vulnerable most of those economies were to these agreements where they were dependent on imported fuels, etc. At the same time, the opportunity is that there's a lot of money out there. I mean, there have been these huge announcements here at COP, and we have to do something about it because it's just, I mean, the CHP announcements are, I mean, Glasgow had the $8 billion for South Africa 2 years down the road. It's still around. I mean, how are you going to bring that to real projects and real implementations? So there's a lot of support and there's a lot of talk about supporting the Global South. We need to really invest in innovative solutions and real up-to-the-ground solutions. What we're trying to do with the iTrust is that, I mean, bring the support of those that want to take some of the upfront risk, that can be patient enough, and stack them in a capital structure that makes sense, and walk the talk of the blended finance and the de-risking, and make it work for the poor people. Because if you do that well and you do that upfront, you can really have a more sustainable price of electricity and a more sustainable clean energy market in many of these countries. It's not impossible, right? We did it in Argentina with all that means. For those that are not familiar, the Argentinian government, or Argentina as a country now owes the IMF $60 billion approximately. The second one in the list owes 15, So that's the kind of exposure the country has, but is saving $1 billion every year in fuel imports because of renewables. And it can be done. And the prices went down significantly. So it can be done.
Anna, any thoughts on how to make commitments real? We've all heard about that gap. People always talk about level of ambition at COP. I think we should also talk about the expectations gap in terms of implementation. One of the things often heard in African markets is there's not enough bankable projects to actually get that capital to move. So any last thoughts on that before we close?
I think the innovation that we just talked about is required to be done in collaboration with the public sector. This is why we set up our offices in Southern Africa and Zambia. This is why we work with the utilities. The financial architecture, we believe, are there. The blended finance convergence report recently showcased the decrease of the ability of the blended finance to actually get disbursed on the ground. So in our case, it's really, I was a project finance lawyer for 17 years in London, packed up my bags and moved my family and I and our dog to Lusaka. And we are working with the utilities on a daily basis. I don't even travel. I'm here for COP because I'm signing with the utilities. Otherwise, I wouldn't be here. The money is there. But our collaboration with the utilities, taking them through the journey, understanding the dispatch rules, understanding the unbundling of tariffs, understanding of all of that, we need to walk that journey with them through new business models, that then they see the monetization of their services and then they are open to this transition and journey. Otherwise, we are financially engineering, bringing project, giving high IIRs, connecting to their grid and leaving them to, to be. So we need proper advice to governments on the granular nature that you expressed, and then we need businesses on the ground to actually work with the public sector and state utility actors who own that infrastructure to make it happen.
But how do we get 100 more of you?
Well, we are a pathfinder. I can already tell you 10 companies that are moving in our stride, and it's fantastic. So it'll happen. You need to demonstrate, and then the flow will happen. It's just as long as no one messes it up, because as you quite rightly say, it's a very tricky thing, market liberalization and opening. Traders don't have a good name in the world for right reason. So God forbid we do something wrong, we can take away the liberalization of the power sector back by 10 years. Yeah. So this has to be superbly well planned, or we are actually defeating the ultimate objective we want to fulfill.
Well, thank you both. It's an honor for me to have had this conversation with two pioneers in the space and for bringing that cross-market perspective, Mauro. I'm always grateful for that. And Anna, for the pioneering work you're doing in Southern Africa. Thank you so much for taking time out of your schedule from this busy period at COP. And thank you all, both those of you in the room and those joining virtually. And enjoy some of our future programming. So thank you very much.
Thank you.
Thanks.